is a huge nothing burger. This is the third deal that China has done. The other two countries are Pakistan and Brazil. And the reason why is I see like people on Twitter now breathlessly rambling on about de-dollarization and all of this stuff. And I think if any of these people would think from first principles, the first thing that you would know is that the yuan is pegged to the US dollar. And so as long as it's pegged, whether you trade through the US dollar or you don't and you directly go to yuan, you're indexed to the US dollar. And then you use a dollar swap to convert it into the currency you need. So I don't know. I think this is kind of like a lot of folks who don't really know what's going on.
In this video, Chamath Palihapitiya discusses China's recent currency swap deal with Iran and its potential impact on the global economy. Chamath argues that the yuan is currently pegged to the US dollar, which means that it is still reliant on the dollar for conversion, regardless of whether countries trade directly with China or not. He emphasizes that China's dominance in trade and its central bank's large foreign reserves are a result of this currency peg, which allows China to manipulate its currency and gain traction in countries worldwide. While they acknowledge the risk of dollarization, Chamath argues that until the yuan becomes a free-floating currency, it is impossible to know its true market clearing price. He suggests that the risk of dollarization is growing due to the U.S.'s massive debt and deficit and the weaponization of the dollar as a political tool. He also argued that the U.S.'s use of sanctions and seizure of foreign currency reserves could make countries view the dollar as an unreliable store of value, leading to a potential shift towards other currencies. Before we get into this video, please like, subscribe, and leave your comments in the box below. Now, let's hear what Chamath has to say.
The reason why China has had so much dominance as a trading partner, and the reason why China's central bank has the largest amount of foreign US dollar reserves, about $3.5 trillion, is exactly because of the thing that you want to ignore in order to have this highfalutin intellectual conversation. It is pegged to the US dollar. And until it is unpegged in a free-floating currency, we will never know what the real market clearing price is.
And so
China has been able to, China has been very effectively able to manipulate this currency since they were brought into the WTO in order to engender that trading partner status. They were able to artificially suppress the value of their currency so that exports from China could gain traction in countries all around the world. You have to take into account this currency peg. And you have to ask the question, where would the currency be if it wasn't free floating? And then what would the incentives be for folks to replace the dollar? And I think that there's a lot of interesting questions there that are worth asking, but I think you have to be a little bit more intellectually honest to have the discussion.
And just for clarity, Chamath, you said they already have these deals with Pakistan and Brazil.
And Russia.
You meant Pakistan and Russia, I think. They already have those deals with those two.
Pakistan and Russia.
Right. Okay, good. I just want to make sure it's clear there. Sachs, do you have any thoughts on this? Is this an example of people just maybe taking the Ray Dalio book and it fits a certain narrative and overhyping it? Or do you think this is an actual real trend in the world to be concerned about?
I think de-dollarization hasn't happened yet, but I think it's a risk. And I think there's a bunch of reasons why the risk is growing. So first of all, we have $32 trillion in debt. Someone has to finance that debt. And the bigger that number gets, the more unattractive our debt is because they have to be concerned that we're eventually going to monetize the debt, pay it back by printing a bunch of new dollars. So that's point number one is we have these massive deficits and debts. Number two is that we have, I think in the last couple of years, really weaponized the dollar. So if you look at like what we've done with Ukraine and Russia, we basically seized hundreds of billions of dollars of Russian reserves that were held in dollars. We've excluded them from the SWIFT banking system. We've imposed massive sanctions on them. And in fact, we now have sanctions on a huge number of countries all over the world. So we're very sanction happy, all of which makes these countries view the dollar as an unreliable store of value. Why would you store your money in something that can be taken away by the U.S. and specifically by the State Department? So I think this is a major change in the way that we view the dollar over the last couple of years is we're going to use it as a weapon. That makes it viewed.
Well, that's not the first time we've ever done that, right? We've done sanctions against many different
We've done
dictatorships.
sanctions, but as far as I know, we've never seized foreign currency reserves and excluded a country from SWIFT, which is the banking system. So as an instrument of U.S. foreign policy. So, I mean, I could be wrong about that, but this was a major event when it happened. Remember, we also did stuff like seize the yachts and the foreign holdings of Russian oligarchs. Remember their ill-gotten gains? We suddenly decided they were ill-gotten. Let me tell you, we didn't think they were ill-gotten when those Russian billionaires were buying those yachts or buying New York real estate or London real estate.
Or investing in Facebook.
Or investing in companies here or buying sports teams or what have you. So we didn't think they were ill-gotten. Hold on. We didn't think they were ill-gotten at the time that they were actually made and spent, but we decided subsequently we're just going to seize those things. Well, again, if you are a foreign country or a wealthy person in a foreign country and you're just trying to decide where you're going to keep your money, you may not want it to be liable to the vagaries of U.S. foreign policy. So I think all these things do matter. And when you're running the kind of debt and deficits we have, and you're making the U.S. dollar less attractive, you are running a risk. I mean, that's
so we
the
should
fact.
be keeping people we have disagreements with on the dollar standard because that's good in terms of power for us, which I think opens us up to a broader discussion.
Well, hold on, just to clarify this, it's not even the dollar standard, right? Like what this deal was is to use this thing called SIPS, and SIPS is the non-dollar competitor to SWIFT. And so you settle, right? Across, let's just say you have two trading partners in two completely different countries that use a bank in each of their local areas. They typically swap to dollars and then they transfer, right? Using this backbone of the financial infrastructure called SWIFT. China has built a competitor to it called CIPS, CIPS, and China's been going around and signing folks up. Makes a ton of sense, right? Hey, listen, if we're trading between each other, let's just use that. So I think it's important to not paint this with more of a brush than it should be. I'm not saying that de-dollarization couldn't happen. I just think that everybody tries to take one random data point and conflate it all together to reinforce a Ray Dalio point from a book 3 years ago.
I do think there's a group of catastrophists who maybe are hoping this happens, or it's great Twitter fodder.
I think we are headed for some sort of government debt crisis. I said that there's going to be three prongs to this financial crisis. One was these long-dated bonds having unrealized losses, which is causing problems in regional and community banks. The second piece of it's the commercial real estate crisis, which I think is metastasizing right now, which is also going to be a banking crisis once all those unrealized losses come due. And the third piece of it is government debt crisis. We have this $32 trillion debt that we're now having to refinance at much higher interest rates. I read somewhere that half our government debt, so $16 billion, is going to come due, trillion, yeah. And it's going to have to be refinanced in the next 3 years. The average rate on that debt is 1.7%. Well, if you want to refinance it at 10-year rates, you're going to be looking at somewhere between 3.5% and 4%, maybe more. So you're looking at a doubling of the interest costs. And I also read that by 2030, we're going to have over $1 trillion of interest expense owed by the U.S. government every year. That is money that's not funding anyone's Social Security. It's not funding anyone's healthcare. It's not funding one weapons program. It's not funding anything we want. It's the VIG. It's going to be more than a quarter of our total federal budget.
Yeah. And this is where you start gambling. When you're chasing that VIG payment, you start taking risks.
This is also where you have to expect the Fed will really want inflation to stay high. That's sort of what we've said before. The only way out of this mathematically is to keep rates high. But the other thing, David, that when you mention all of this is, what about every other country? If you think that's happening in the United States, I think it's important to make sure we at least consider every other major economy, because it's not as if they're pristinely sitting on the sidelines while this happens to the US. This is my whole argument the whole time, which is if you're going to have this argument, you need to do it thoughtfully and relatively, right? Because the euro is in the same amount of trouble. If you look across, it's not as if China is actually sitting pretty and smelling like roses either. Every major economy or trading bloc in the world is going to go through this at the same time. So it becomes a relative trade argument. And there, I just don't know enough to know whether the US is poorly positioned versus Europe or China. But it just seems like you get back to a place where it's like, okay, we need to find the flight to safety. What is the canonical flight to safety? If it's not a commodity like gold, it's probably the dollar until it's not.
What are your thoughts on the Fed's unrealized losses? Why do you think the Federal Reserve is not prone to the same types of regulations as commercial banks? Let us know in the comments below. Thanks for watching.